Joined now by Lance Ippalito, CEO of the Future of Trading. Lance, welcome.
Hey, Jeff, how are you?
We're doing all right over here. Lance, we're looking at the FANG stocks here. The S&P is taking it on the chin a bit this week as the influence of the coronavirus's continued spread around the planet undermines confidence in markets. What's the opportunity for options traders in this type of environment?
So you always hear everyone talk about, if I can only buy Facebook, Microsoft, Google, Amazon, Netflix at a discount, well, here's your discount actually today, right now. You have the big FANG stocks. They're set to report earnings this week and next week. If you're wanting a dip to buy them, if you're wanting to play cheap out-the-money call options for a favorable risk versus reward, try to hit that 300, 400, 500% gain, you're getting this Monday dip with the virus spooking the markets right now to play it. So most traders, they don't want to buy the dip. They don't want to buy when there's fear in the markets. You have to look at the big picture. You got big FANG. They're reporting earnings this week. If they beat, you're going to have a massive move higher in those FANG stocks. And really right now is the opportunity.
Right. Okay, so then what's the risk that the dip becomes a downturn that persists, and how do you protect yourself against that in the options universe?
Well, the beauty with options is you can only lose what your initial premium you pay for. So when you buy a call option, for example, let's say you buy a $1 call option. So that's representing $100 per one contract. That's the most money you can trade. Unlike if you were to buy, let's say, Facebook stock, and after earnings it went down $20, then you're on the hook for that $20 move in each share of stock that you own. So you're getting a limited risk with the option strategy if, let's say, Facebook and these FANG stocks, they continue to dip even post earnings. Unlike the stock, you're left, hoping and wishing that the stock eventually trades back higher. And listen, I don't have a crystal ball. I'm not a doctor. I'm not a scientist who's going to cure the virus spreading over in China. So we could see more downside action. Again, the beauty of options, you're limiting your risk and you're actually maximizing your reward if they do trade higher.
Sure. How important is liquidity to the whole options equation?
The beauty with these FANG stocks is they trade mostly hundreds plus thousands of contracts a day. And a name like Facebook and Microsoft, they have penny-wide options. So liquidity, you're pretty much taken care of. You don't have to worry too much about liquidity. Unlike, let's say, a Google and Amazon, their spreads are a little bit wider. But again, they're going to trade so many options during earnings that you really don't have to worry about liquidity issues.
Sure. Okay, and so why are the FANG stocks so on fire? What's driving? They just seemed relentless in their march higher.
You look at, let's say you're a hedge fund manager, right? And the S&P is returning 30% a year or so. These hedge fund managers, they have to outperform the S&P, and the only way they're really going to outperform is where there's growth and where there's money flowing into. And really for the past 8 years, and I think as long as interest rates stay where they are and the Fed, stays okay, we'll put it there, you're going to continue to see fund managers continue to buy FANG stocks, and unless something drastic happens, or unless you think Google or Amazon somehow is going to slow down, you're going to continue probably to see every dip be bought like we have for the past 8 years.
Sure. The FANG stocks seem to be also responding a bit negatively to the coronavirus threat and scare. So is that something that just really presents an opportunity for somebody who wants to buy the dip, or is it potentially a longer-term threat? I mean, if you're only on the hook for the cost of your option itself and not for the downside, I guess at some point you either reverse your theory and play the short side, or do you just stay out of the market altogether and wait for a more discernible pattern?
a good question. It kind of reminds me of, remember the whole Ebola scare? I think that was, what, a number of years ago. It
Yeah.
was really short term. The S&P actually went 15% lower, and then 3 months after, it had a V-shaped bounce and was actually trading 25% higher. In my opinion, again, I'm not a medical doctor or a scientist, but usually when we have negative news, money will come out of FANG stocks because they've ran up so far, so really so quickly that you'll have profit taking in those high beta names. And then as soon as you have, let's say for this virus, the worries and the cure is solved and just we bypass it, you have money go right into those FANG stocks all over again, and that's what causes that bounce. Listen, if you're worried, if you're scared, you don't have to play. You don't have to be in the market. That's the beauty of trading. It's your money. You do what you want. But if you do think there's an opportunity, and historically these short-term dips on whether it be illnesses or diseases or fears in the market, they've seen higher prices shortly after.
Right. Okay. So then, what are some of the strategies that you can use to really capture a rebound in the stocks through an options strategy?
I want to go over two strategies, and they're both very simple to do, and as a trader, as an investor, anyone can do them. Number one is a premium selling strategy. So you're basically putting 50 bet. It's called a bull put credit spread. So unlike selling a naked put where you can get assigned stock and that you do have a limited risk to the downside, you're actually buying an out the money put, selling it in the money put. So a neutral strategy on the, as long as it stays at price level by expiration, you're good. So you're basically risking $50 to make $50, and the stock doesn't even have to move higher. So it's a very conservative, neutral strategy that traders can do for a high probability percentage to really double their money. Another strategy, and this is more aggressive, is buying calls. The negative with buying calls is around an earnings event or when there's fear in the market or uncertainty, option prices increase. So those call options are going to increase. But if you do have a V-shaped bounce or a sudden aggressive move higher in a stock, the call options are your best bet for the greatest return possible on a trade. So I'll go over a hypothetical situation. Facebook has earnings. Facebook stock right now is trading right around $2.15. The market makers are implying a $15 move higher or lower on earnings. So that's $200 to the downside, $230 to the upside. Let's say Facebook trades $250. They have a fantastic quarter. They beat analyst expectations. You can buy those $230 calls for about $1. And if that stock goes to $250, pardon me, they're about $2. $2, if Facebook trades at $250, those calls are going to be worth $20. So that's 10x your money in a matter of weeks if Facebook has a positive earnings result.
Right. Okay. So then now, if I'm an individual investor, what is the best platform for a small trader in the option space to get their feet wet, so to speak?
There's so many options now. It's really a fantastic time to be a trader. I use TD Ameritrade Thinkorswim. It's very advanced. You can get every feature you ever asked for, especially if you're a big math fan, via option stats, probability analysis. It goes into all the Greeks and detail. It even has education, fantastic charts and scan features. It's a little more pricey. They just merged with Schwab, so they cut for stocks, it's free, but for options, it's still 65 cents. If you're more into swing trading and less, more conservative, not so aggressive, you're not trading hundreds of orders a day, I use Robinhood. They have a web-based platform, of course, mobile on your phone. It's completely free for trading options, And in my opinion, it's really not that bad. I've used pretty much every platform out there. I spend tens of thousands of dollars a year on commissions, and it's free. And I'm saving a ton of money using Robinhood on one of my accounts, and I like it. So you can't go wrong now. You have options, and that's always beautiful.
Right. Okay. In what general market conditions is trading options better than trying to catch a run to the upside or the downside in stocks?
So when you trade options, especially when you buy call options, betting a stock goes higher, when you buy put options, thinking a stock moves lower, you really only need some kind of volatility in the market because volatility creates opportunity. And when you're trading directional, whether it be up or down, that's what you really want as an options trader. When the market's flat and not doing anything, it can be really boring because you don't have as many opportunities to move higher in a stock. So like right now, with the virus scare, and you do have the market moving, we gap lower today. We might gap higher 50 handles in the S&P tomorrow. If you're trading options, that's what you want because it presents opportunity to trade.
Right. All right. Well, that's a great introduction there, Lance. We're going to leave it there for now. We'll come back to you next week. Thanks very much for joining us today.